Have you ever wondered why your grandparents' stories of nickel candy bars seem like ancient history? Why does the cost of living consistently trend upwards, impacting everything from your daily coffee to long-term investment strategies? Today, we delve into the fundamental economic forces driving this pervasive phenomenon, the persistent rise in prices over time. Prices are not arbitrary figures. They are critical signals within a market economy. They convey vital information about scarcity, production costs, and consumer preferences. For economists and financial analysts, understanding price movements is key to assessing market efficiency. These signals guide resource allocation, influencing what is produced and consumed. When prices rise across a broad spectrum of goods and services, it indicates a systemic shift, not merely isolated market fluctuations. This distinction is crucial for accurate economic analysis. A primary driver of sustained price increases is the changing value of money itself. When the supply of money expands faster than the economy's capacity to produce goods and services, each unit of currency tends to purchase less. This erosion of purchasing power is commonly known as inflation. Central banks, through monetary policy, significantly influence this dynamic. Decisions regarding interest rates, quantitative easing, or reserve requirements directly impact the money supply. Investors and financial analysts closely monitor these actions for their inflationary implications. History offers compelling evidence of this relationship between money supply and prices. In ancient metal-based monetary systems, periods of relative price stability often coincided with limited growth in the money supply. Conversely, debasement of coinage or discovery of new metal sources frequently led to price surges. The transition to modern fiat currencies, unbacked by physical commodities, has amplified this effect. Governments and central banks now possess greater flexibility in managing money supply, which can lead to more frequent and pronounced inflationary episodes. Students of economic history can draw parallels across centuries. It is essential to distinguish between general inflation and specific price increases. Not every rise in cost signifies broad inflation. Individual prices can climb due to microeconomic factors affecting particular sectors or products. These factors include higher production costs, such as rising raw material prices or labor expenses. Supply chain disruptions, increased demand for specific goods, or new regulatory burdens can also elevate prices. For investors, discerning these nuances is vital for portfolio management. Beyond monetary expansion, other forces contribute to price increases. Cost push inflation occurs when the cost of producing goods and services rises, forcing businesses to pass these costs onto consumers. Examples include energy price shocks or significant wage increases. Demand pull inflation, conversely, arises from robust consumer and business demand outstripping the economy's productive capacity. Strong economic growth, coupled with expansionary fiscal policies, can fuel this type of inflationary pressure. Both dynamics require careful consideration in economic forecasting. While temporary price declines or deflation can occur, sustained long-term deflation is rare in modern economies. This is partly because central banks generally target a low, positive inflation rate to stimulate economic activity and avoid deflationary spirals. Deflation can be detrimental, discouraging spending and investment. Furthermore, nominal wages tend to increase over time, and economic activity generally expands. These structural forces create a persistent upward bias in the overall price level. Understanding this long-term trend is fundamental for personal finance planning and investment analysis. Inflation is not just an economic phenomenon. It also has a significant psychological component. Individuals often anchor their perceptions to past prices, making current increases feel more dramatic or alarming. This cognitive bias can influence consumer behavior and wage demands. Inflationary expectations, once entrenched, can become self-fulfilling prophecies. If consumers and businesses anticipate higher prices, they may adjust their spending and pricing strategies accordingly, further perpetuating the cycle. This behavioral aspect is a key consideration for policymakers. For investors, understanding the drivers of inflation is paramount. Assets like gold and silver are often considered hedges against inflation and currency debasement. Their value tends to be measured against the purchasing power of fiat currencies. When the value of money erodes, precious metals, which have intrinsic value and limited supply, can maintain or even increase their purchasing power. This makes them a component of a diversified portfolio for those seeking to preserve wealth during inflationary periods. Financial analysts often include them in their risk management strategies. In summary, the persistent rise in prices over time is primarily a function of changes in the value of money driven by monetary policy. While specific factors can influence individual prices, broad and sustained increases reflect underlying monetary conditions. This analytical distinction is crucial for students, investors, and economists alike. In our next discussion, we will explore the critical differences between inflation and the cost of living, clarifying why these terms are often mistakenly interchanged. This will further refine our understanding of economic dynamics. Disclaimer: this content is provided for educational and informational purposes only. It does not constitute financial, investment, or economic advice. Always consult with a qualified professional before making any financial decisions. If this analytical overview has deepened your understanding of inflation and its implications, please consider liking this video. Your engagement helps us produce more in-depth economic content for students, investors, and financial professionals. Share your thoughts in the comments below and subscribe for further insights into global economic trends. Thank you for watching, and we wish you a productive day.